In the spring of 1720, Sir Isaac Newton, the man who discovered gravity and invented calculus, invested in the South Sea Company. At first, he made a massive profit and sold, but then he watched his friends getting richer. Unable to control his emotions, the smartest man on earth bought back in at the absolute peak. When the bubble burst, Newton lost £20,000, the equivalent of over $4 million today. His famous quote, "I can calculate the motion of heavenly bodies, but not the madness of people." Here is the most dangerous myth in personal finance. If I have a high IQ, I will easily build wealth. The truth is exactly the opposite. Doctors, engineers, lawyers, and tech executives are statistically some of the worst investors on the planet. Today, we're stripping down the psychology of the intelligent investor's failure. We will look at why Nobel laureates blew up a $100 billion fund, why your brain's ability to solve complex problems is sabotaging your retirement, and how to unlearn your own intelligence to finally get rich. Welcome to the Golden Bowl Masterclass. Let's start with the ego. If you are a neurosurgeon or a senior software engineer, you have spent 10 to 15 years mastering an incredibly difficult domain. You are used to being the smartest person in the room. This creates what psychologists call the halo effect of intelligence, or the God complex. Because you are brilliant in one complex area, your ego tricks you into believing you are brilliant in all areas. This is where smart people step outside their circle of competence. Warren Buffett famously said, "You don't have to be an expert on every company. You just have to be able to evaluate companies within your circle of competence." The size of that circle is not very important. Knowing its boundaries, however, is vital. Smart people refuse to acknowledge boundaries. A brilliant dentist will suddenly decide they can day trade crypto derivatives or flip commercial real estate because they read a few white papers. They enter a zero-sum game against Wall Street algorithms and institutional insiders who do this 100 hours a week. The result? The smart professional gets slaughtered, not because they are stupid, but because they played a game whose rules they didn't respect. If you don't believe that high IQ destroys wealth, let me tell you the story of long-term capital management, or LTCM. In 1994, a hedge fund was launched. It wasn't run by regular guys. It was run by the absolute titans of finance. The board of directors included Myron Scholes and Robert Merton, two men who literally won the Nobel Prize in economics. Their team had more PhDs than most universities. They built incredibly complex mathematical models to predict bond prices. For a few years, they looked like gods, making 40% returns. They believed their math was flawless. Because they were so smart, they believed there was zero risk, so they used extreme leverage. For every dollar of their own money, they borrowed $25. Then, in 1998, Russia defaulted on its debt. The real world did something their mathematical models said was impossible. Because of their massive leverage and unshakable arrogance, LTCM lost $4.6 billion in a matter of months. The U.S. government had to step in to bail them out to prevent a global financial collapse. The lesson? The market doesn't care about your PhD. It doesn't care about your algorithm. When smart people fail, they fail catastrophically, because their intelligence gives them the confidence to take on risks that an average person would be terrified of. Why did LTCM fail? Because of complexity bias. This is the tendency of the human brain to prefer complicated explanations and solutions over simple ones. For a high IQ individual, buy a low-cost S&P 500 index fund and wait 30 years feels insulting. It feels too easy. Their brain is a Ferrari, and you are telling them to drive 20 miles per hour in a straight line. They want to shift gears, drift corners, and outmaneuver the traffic. So they build a sophisticated portfolio. They buy individual tech stocks, hedge with gold futures, invest in private equity syndicates with 10-year lockups, and pay wealth managers 2% a year for exclusive access. They spend hundreds of hours analyzing data to squeeze out an extra 0.5% return, completely ignoring that the fees and taxes of their complex strategy are eating 3% of their wealth. The data is clear. Over a 20-year period, more than 90% of actively managed funds underperform the simple, boring index. Smart people sacrifice their net worth on the altar of sophistication. This brings us to the optimization trap. Smart people are obsessed with efficiency. They will spend 40 hours researching the absolute best credit card to get 1.5% cash back instead of 1%. They will construct elaborate tax loss harvesting spreadsheets to save $500 on their tax bill. But while they're using their immense brain power to pick up pennies, they are stepping over dollars. They optimize their coffee budget but ignore the fact that they have $150,000 sitting in a checking account losing 4% a year to inflation because they are waiting for the right time to buy the dip. They are micromanagers of their money but lack a macro vision. They win the daily battles but lose the financial war. In the Golden Bull philosophy, we call this being majoring in minor things. If you spend more time researching which high-yield savings account gives you an extra 0.1% than you do increasing your earning power or buying hard assets, your intelligence is working against you. When the market crashes 30%, your IQ drops to 0. Investing is not a test of intelligence, it is a test of emotional regulation. Smart people are used to solving problems by doing something. If a project at work is failing, they work harder, they pivot, they fix the code. But in the stock market, when your portfolio drops by $100,000 in a month, the correct action is usually to do absolutely nothing. This drives smart people crazy. The urge to act, to fix the portfolio by selling at the bottom, is overwhelming. They invent incredibly logical, data-driven rationalizations for why this time is different and why they need to go to cash. Intelligence helps you understand the asset, but only emotional intelligence helps you hold the asset when the world is screaming that the sky is falling. As Morgan Housel says, doing well with money has a little to do with how smart you are and a lot to do with how you behave. If you are a high-income, high-IQ professional, how do you cure this disease? You have to dumb down your finances to achieve elite results. Here is the Golden Bull blueprint. Step 1. Accept average to achieve exceptional. Admit that you cannot beat the market. Buy the market. Broad market index funds are not for the lazy, they are for the rational. Accept average market returns, and over 30 years, compounding will make you exceptionally wealthy. Step 2. Automate and delete. Your brain is your worst enemy in a panic. Automate your investments so money leaves your account the day you get paid. Then delete the investment apps from your phone. You do not need to check your 401k on a Tuesday morning. Step 3. Direct your brain power elsewhere. If you have a high IQ and a need for complex problem solving, use it to build a business, advance your career, or create a side hustle. Treat your career as your active, complex investment and treat your portfolio as your passive, boring vault. Intelligence is a beautiful tool, but in the world of money, it is a tool that is highly prone to backfiring. Stop trying to outsmart the system. Build a system that makes you rich while you sleep. Thank you for watching this masterclass. If you're ready to stop playing ego games and start building a real empire, subscribe to Golden Bull Theory. Keep it simple, stay disciplined, and I will see you at the top.